Good evening, class, and welcome to our advanced taxation class this evening. We are going to be looking at the topic concept of total profit. In our taxation jargon, we will be using the phrase or the words total profit a lot. What does total profit entails? How do we calculate our total profit? You will be seeing things such as adjusted profit, accessible profit, and total profit. So these are the order in which these things will appear in our format. Of course, you'll be seeing the format of how to calculate your total profit, then to get your taxation from that. Then we will be seeing the tertiary education tax, the objective of it, basis of computation, assessment and collection, the management and administration of the debt fund. They will be talking about other bases for computing company income tax payable. We have things like the minimum tax basis. What is it? Then we'll also be seeing things like what the provision of Finance Act 2019 and 2020 have to do on minimum tax. Then we'll be seeing the revenue or turnover basis in section 30 of SITA. Then we'll be looking at the dividend basis. Then we'll also look at dividend distribution by Nigerian companies. Then we'll talk about the dividend distribution treatment of certain undistributed profits as distributed anti-abuse. Then we'll be looking at some worked examples at the end of the whole thing. So these are some of the things we are to know in this topic. And this is a very important topic because total profit is widely used in our computation. Now let's look at some definitions. What is adjusted profit or accessible profit? So sometimes we use these two interchangeably because in some cases they mean the same thing. Adjusted profit is determined by taking the net profit made by a company during the basis period. Then we will now add back disallowable expenses that has been deducted when arriving at the net profit. Then we will also add some other taxable income that was not reported when the net profit was calculated. Then we will less some allowable expenses that are not reported. And we will less non-taxable income that was included in the net profit calculation. So it means that in our calculation of accessible profit, our base, our starting point is the financial accountant's net profit. So it means that we are looking at the same net profit prepared by the financial accountant or the information that was given. So it means that if a company has two kinds of accountants, let's say financial accountant and tax accountant, their profits will be different. Because a lot of things that is considered by the financial accountant will not be considered by the tax accountant and vice versa. But most times, instead of having the two accountants working simultaneously, one takes off from the other. So it means that even though the tax accountants will be using the same information given by the financial accountant, the tax accountant will start from the profit determined by the financial accountant. And he has to examine everything that is being done. So it means that looking at that profit, he will look at what are some of those disallowable expenses that was deducted. We will find out. Then there are some profits that were not reported. He's going to include it. Then there are some allowable expenses that were not deducted. He's going to do that. And there were some profit income, there was some income that is reported, but in the eyes of the tax accountant, this income is not supposed to be taxable. It will be deducted. So when we do all of these adjustments, you arrive at what we call adjusted profit. In most cases, adjusted profit is the same as assessable profit. Okay? What is total profit? The total profit is arrived at after the deduction of loss relief and the granting of capital allowances from adjusted profit. So I said before that adjusted profit and assessable profit are usually the same, but sometimes they may not be the same if we have something called loss relief. So when a loss relief is granted, like what we did the last time, we did our loss relief, it means that the next result after loss relief has been granted is assessable profit. So it means the first one that you have before the loss relief, we can call it adjusted profit. Some will still call it assessable profit, is fine. So I will say adjusted profit 1 or assessable profit 1. Then when a loss relief has been applied, we have adjusted assessable profit 2. Then we will now have the capital allowances. After the capital allowances has been removed, we have something called the total profit. Now look at the format. First, we start with the net profit from the financial accountant, which happens to be this here. Then we are adding back all disallowed items. For example, in the financial accounting, you must have seen depreciation. It was deducted, and so it will be added back. Then sometimes you will see capital expenses on shares. So all the expenses you made on share capital when you are issuing shares or so, or you are buying shares, all those expenses you make, it will be added back because they are not allowable. Then we have rent disallowed. Rent disallowed. So it means that there are some rents that are not allowed. We'll get to find that out. Then we have donations. Not all donations are allowable. So there are some allowable donations and disallowable donations. Then we have provisions for bad debt. If there are general provision for bad debt, it is not allowed. It will be added back. Then diminution in the value of our investment. Diminution means reduction in the value of investment. Maybe you do a revaluation and you reduce the value of your investment and you want to take away that reduction. No, that is not allowed. Then, what are some of the things that we are going to less? We are going to less profit on the sale of plants and equipment. Maybe because you made, when you are doing your income statement, so it's called comprehensive income and other comprehensive income or other income. You now have a profit on the sale of plant and machinery. You now added it in your net profit. Here we are going to less it. And the same thing too, if we had a loss on the sale of property plant, it would have been deducted. We will be adding it back. Then profit on export sales. Then non-taxable incomes. Non-taxable incomes. For example, interest on agric or export loans. All of these are non-taxable income. We are going to less them. Then, when we do that, what we have is our adjusted profit, or we can call it accessible profit. I call it accessible profit 1. Then the next thing to do is your loss relief. When you less your loss relief, you have your accessible income 2. Then you have to add back again. If you have a balancing charge, which is opposite of balancing allowance, you will add your balancing charge after your loss relief. If you have investment allowances, this is rural investment allowance. You less that first, and you have your accessible profit 2. This is accessible profit 3. Then at that time, you can now less your capital allowances, your initial allowance, your annual allowance, your balancing allowance. When you have all of them together, this is your capital allowance claimable. Then, if it is a company that is restricted to 66 to 3rd%, you restrict it and you take it down here. If it is a company that is now restricting it, you compare whether your claimable capital allowance is also equal or more than the accessible profit 3. So whichever is smaller is what goes here. Then if it is restricted or not, there's a capital allowance you will carry forward to the next period. And then you calculate your total profit. So that's how we get to look at our total profit calculation. Then we have companies income tax payable. Now using applicable rates based on total profit. So we have small companies, medium-sized companies, and large companies. So a small company is 0%. You don't charge them tax. That's why you see the words here, excluding small companies. So a medium-sized company is company that is from 25 million to 100 million. So a small company is below 25 million. Medium size is between 25 million to 100 million. And large companies is over 100 million. Use 30%. When you do that, you get your company income tax, your tertiary education tax, Depending on the year of assessment, it could be 2%, it could be 2.5%, depending on the year of assessment. For small companies, you don't charge tertiary education tax. So when you add these two, you have your total tax payable. So that's it. Welcome to the area of tertiary education tax. What is tertiary education tax? How is it being applied? The tertiary education tax, which is also called TET or TET, was introduced in 1993. So it means the TET predates the 1999 Constitution. And the act aims at improving the private sector being the beneficiary of a product of education, making them to partake in funding tertiary institutions. So it means that not only is government going to be a major fund provider for tertiary education, private companies, private Nigerian companies were now made to participate in providing funds to assist tertiary education. And now the fund was used to maintain the following: essential physical infrastructure for teaching and learning, instructional materials and equipment. It's also used to fund research and publication, then academic training and development, and all that. The basis for computation of TET, as we said, is 2% up till 2021. In 2022 year of assessment, it increased to 2.5%. Now, the assessment and collection, the tertiary education tax is being collected by the Federal Inland Revenue Service on behalf of the government, and the government use it to provide fund for tertiary education, and it is being distributed to funds to help universities, tertiary education, polytechnic and college of education. The, the rate of distribution to university is 50%, while that to polytechnic is 25%, colleges of education is 25%. So it means that it's a ratio of 2:1:1. So that's how it is being distributed. What are some of the offenses and penalties? If TET is not paid within 60 days, a demand notice for the unpaid tax and a sum which is equal to 5% of the tax will be issued in the demand as penalty. So 5% of the sum unpaid is penalty. In addition to that, there will be interest of the unpaid sum at the bank lending at the CBN lending rate, and it is payable until it is calculated on a daily rate until it is paid. So it means that if TET happens to be 1 million naira, and in after 60 days it is not paid, you will be adding 5% of 1 million, which happens to be um, 500,000. No, 500, yeah, 1 million, 10% is 100,000. Okay, 50,000 is 5%. So 50,000 will be the penalty. Then the interest will be on the 1 million and not on the 1 million 50,000. No, 50,000 will not yield interest. 50,000 is a penalty. So for owing the 1 million to government, you will be paying an interest as if you are using the money for trading. Let's assume that the interest rate, let's say it's 24% per annum. So what they will do is the interest of 24% per annum, which is 0.24, will be divided by 12 to know how much is a month, and they will charge it per month. Or they can decide to divide the 0.24 by 365 so that you know your interest per day. And so what they will do is the interest per day multiplied by the number of days that you have not paid. So if it is on the 70th day that you went to pay, it means that from day 61 to day 70 is 10 days. So the penalty will be calculated based on 10 days and added to your interest. No, and added to your penalty. Your interest will be for 10 days, added to your penalty of 5%, which is non-prorated, and the full sum of the tax that you are supposed to pay. So it's the interest that is prorated on the bank lending rate. If the tax and the penalty are not paid within a further period of 2 months of demand, the company is guilty of an offense. The FRS shall, with the approval of the Board of the Trustees of Debt Fund, remit in whole or part a sum added to the unpaid tax. In short, the guilty person shall be convicted to pay a fine of 1 million naira or imprisonment for a term of 6 months, or even both if he is a first offender. For a second offender and subsequent offense, you will be paying 2 million naira or go for imprisonment of 12 months or pay both fine and still go to prison. So that's how serious the tertiary education fund tax is. Now let's look at this example. Example number 8.1. Zipon Limited extract of operating result as per audited financial statement for the year ended October 31, 2003 is as follows. So it means here that if it is year ended October 31, 2013, what it means that it is year of assessment 2014. Now we have the operating profits, provision for depreciation, interest on borrowed fund, provision for general debts, balancing allowance, balancing charge, increase in capital stamp duty on increase in capital allowances. Then we are told to compute the assessable profit and tertiary education tax for the relevant year. So the relevant year is 2014. So this is the operating profit here. Okay. Somebody is saying guilty persons, is it going to be the directors of the company that defaulted in the payment or the accountant? The guilty person is the owner of the company or the directors of the company, because they are the owner of the company. And it's what the directors approve that the accountant will pay. So it is the company directors that generally prepare the accounting, the financial statements. They're the ones who are going to sign it. The accountant is just a servant. So if the fault is not from the directors and it is from the accountant, if it is the fault of the accountant, then the directors will state that it's the fault of the accountant, and the accountant will defend himself, and the onus will be on the directors to prove that the accountant was the one. And if they can prove and the accountant cannot, then the accountant is guilty. But naturally, it is the directors. Okay, so look at the solution here. Let's look at it. We have the profit as per account, which is this 1490. So this is what the financial accountant has computed. Then this is all the things that happen with it. Then we are adding back disallowable expenses. We have depreciation 610. General provision for bad debt was given to us as 390. Stamp duty on increase in capital, this 180 is here. Add them up and we got accessible profit of 2670. And that's your accessible profit. So we are asked to calculate accessible profit and not total profit here now. Accessible profit, and we are to calculate the tertiary education tax. Tertiary education tax is going to be 2% of the accessible profit, which gives us 53.4. All right, so we have classifications of Nigerian companies, tax implication. Now, provisions of the Company Income Tax Act prior to the commencement of Finance Act 2019 was that all companies are liable to the same company income tax rate of 30%, with the exception of small businesses. Then the definition of a small businesses would be a company that has a turnover less than 1 million naira. So those people with turnover of less than 1 million naira were called small companies, and they were to pay a reduced rate of 20%. But when Finance Act 2019 came in, the definition of a small company now changed. Now, small company are those companies that have annual turnover of less than 25. So this is not of 25 million and below. The moment it is less than 25, you are a small company. 25 is the borderline. Once you hit 25, you become a medium-sized company. So 25 to 100. So these two borderline, 25, 100. So if you are in between, if you are In 25, there's medium size. If you are in 100, you're a medium size. But if you are less than 100 but greater than 25, you are still a medium size. Then once you cross the 100,000 mark, 100 million mark rather, you're a large company. So the tax is 30% on those ones. So the thing that changed here in the Finance Act 2019 is the definition of small company expanded to 25 up to 25 million. Then inclusion of the medium-sized companies. Then they were not given the rates that small company used to have in those days. They gave it to the medium size, and small companies were exempt from tax. Implications here that small businesses are still required to register for tax. They are still required to audit their financial statements and to file their returns as at when due. If you don't file, even though you are not going to pay, if you don't file, you will pay penalty. They call it late returns penalty. Then small companies are no longer liable to withholding tax on their income, since withholding tax is an advance payment of income tax. And if you're not going to tax income tax, so why would you take withholding tax? Then the Finance Act 2020 stipulates that the FIRS, you have seen a question, does the new regulation on withholding tax affect small companies also? Um, this particular class does not include the new regulation. You will not be tested on the new regulation of withholding tax. I've also not fully digested the new regulation, which is supposed to commence October. So you're not going to be tested, except you want to know that for professional reasons, which is beyond this class. We'll talk about that. But suffice it to say here that small companies are exempted from withholding tax. Only those that are paying 20% or 30% are liable for withholding tax, because withholding tax will be used to claim a relief on their tax liability. Now, the Finance Act 2020 stipulates that the FIRS may prescribe the form of account other than audited financial statement for small and medium-sized company as defined under CETA. So it means that once you are making more than 100 million, you are going to provide audited financial statement. No problem. No problem about that. If you are within the small and medium size, you may not be required to provide audited financial statement, because audit fees may be too high, and a small company who is just filing and is not paying taxes, why will they be required to pay audit fees? A medium-sized company might just be just above 25 billion and will be paying audit fees of how much? Maybe 2 or 3 million. That is too significant. And so they may be required to use the form that the FIRS will provide for them to submit their returns. In line with the provision of the Finance Act 2019, companies' income tax is currently payable at 0%, 20%, and 30% of total profit. So these are the normal basis for computing income tax. The normal basis is total profit. So when they say basis for computation of tax is normal basis, the normal basis is using total profit. So it means that you have to go all the way from net profit, derive your adjusted profit, assessable profit, and when you get to total profit, that is the final basis. You can now apply this rate of tax so that you now have either 0%, 20%, or 30% with respect to your revenue. Kindly explain what withholding tax. Okay, kindly explain that withholding tax. Does it mean that small company cannot withhold on invoices issued to its vendor, but can but withholding tax can be withheld on its invoices being issued? Okay, so look at it now. Withholding tax. What we mean by withholding tax, we mean withholding tax suffered by small companies. So it means that if you are doing business as a small company, let's give example. Let's say Go Getter is a small company, let's say it's a limited company, and it's a small company. If it does business, maybe it does a contract for supply. If it does a contract for supply and you're about to pay Go Getter, normally you are supposed to remove 5% as withholding tax. But now the law is saying that because Go Getter is a small company that will not be required to pay company income tax, there's no need for you to remove the 5% because removing the 5%, he is not going to, how will he claim it? He's not going to claim it. Previously, companies were removing this 5% and they have no way of claiming back those withholding tax. I think that is what the new withholding tax rule is trying to solve. But when Go Getter is the one that is paying, let's say another big company supplies certain things to Go Getter, and Go Getter wants to pay, Go Getter is mandated to remove the withholding tax and then file it in the name of that big company because that big company is liable to pay tax. So it means that these small companies can collect withholding tax and file. But these small companies should not suffer withholding tax. So they should not be asked to make them suffer withholding tax. How can the large or medium size know that their vendor is a small company? The way that they will know is two ways. One, you ask them to submit their tax clearance certificate for 3 years. Their revenue will be stated there, and that is when you will know that they are a small company. So you see their revenues for 3 years, their assessable profit, and their tax paid. Now, it's possible that a company that has reached the threshold of 25 million and because of some factors did not make up to 25 million in some years. You'll find out that because you have reached that threshold, you'll be calculating tax on 20%. So you'll be seeing some companies that is maybe 20 million is their revenue, the accessible profit is small, and you are still seeing tax on 20%. So that tax rate is what should also make you to know that this person is not a small company. So it's not only revenue alone, because the revenue threshold can be met and somebody goes back, but the tax rates can also help you to know. So that's why some people will ask you to bring your tax clearance certificate, bring your VAT certificate when you want to register as a vendor. So this is for them to know whether you will suffer withholding tax or not. I don't know if that has cleared the question. Now, we said the main basis for computing income taxes is is total profit. Now, there are some other bases. Okay, thank you too for clearing and bringing that question. Now, there are some other bases apart from total profit that can be used to determining income tax. Now, one of them is minimum tax basis. According to section 33, we're going to look at that. Then we have revenue or turnover basis. Then we have dividend basis. Now let's look at the minimum tax basis. Now, section 105 of CETA was amended by Finance Act 2020. Okay, and it says that gross turnover means gross inflow of economic benefits during the period arising in the course of operating activities of an entity whose inflow results in increases in equity other than increases related to contribution from equity participants, which includes goods, sales of goods, supply of services, receipt of interest, royalty, dividend. And now it now says that a company, these are the specific exemptions from payment of minimum tax. So we are talking about minimum tax basis. There are some companies that are exempted from minimum tax basis. A company with a gross revenue less than 25 million. So once you have not hit the 25 million mark, you will not pay minimum tax, because minimum tax means you must pay a tax no matter how small. But when you are less than 25 million and you do not pay tax, you should not pay minimum tax. Then another one is a company that is carrying on agricultural trade or business. So it means that a company who is into agro business, if it's less than 25 million, of course, it qualifies for number A. If it's more than 25 billion, he still will not pay minimum tax, because he's into agro business. So it means that if he has a loss, the loss, he will not pay tax. But if you're not in the agro business and you have a loss, total, you don't have you don't have total profit, you have a loss, but you have accessible profits also or revenue, you will still pay minimum tax. Then another one is if your business is not up to 4 calendar years, that is 48 months, you will be exempt from minimum tax. So it means that whether you're an agri business or not, you're earning 100 million or not, if you are within your first 4 years, you will not be asked to pay minimum tax. So it means that if you are setting your template, let's say you're using Excel to set your template and you want to calculate your minimum tax, you'll be doing three conditions. Let's say you're using the if statement to set the conditions. You will now check if the company is less than 25 million in revenue, and if the company is an agro company, and if it is less than 4 calendar years and 48 months. So it means that the date you started the business will also be somewhere, date of commencement. So you'll be using it to check all these criteria. If any of these are met, then you'll be exempt from minimum tax. Now, Section 80 of CETA defines franked investment income as dividend received by one company from another after the deduction of withholding tax. So we are still going to learn something called investment income. So franked investment income. Investment income are those income that you earn when you don't work actively. You did an investment in buying shares of another company. You also provide loan to another company. You are getting interest, or you are renting out your facility and you are getting rental income. All these are investment income. But now, the one termed franked investment income relates to just dividends. So when you buy shares from another company, let me use an example. Let's say Go Getter Limited buys shares from FCA Limited. It means that Go Getter Limited receive dividend. Okay, so if Limited is buying shares and FCA Limited is paying dividends. Let's say the dividend that FCA is paying happens to be 100,000. Okay, Go Getter is supposed to receive 100,000, but by law, FCA Limited is mandated to remove withholding tax from that dividend, and the withholding tax is 10%. So instead of FCA Limited paying 100,000, they are paying 90,000 to Go Getter Limited. Now, Go Getter Limited is receiving 90,000. In Go Getter's book, he is going to record it as 100,000 because that's the gross amount that was supposed to come. But because it has suffered withholding tax before coming to him, that is franked investment income. Now, the following should be noted. Any dividend received without the deduction of withholding tax will not be deducted from, I'll take it again. Any dividend received without the deduction of withholding tax will not be deducted from gross turnover in computation of the minimum tax liability. So it means that if we are paid dividends, you should be getting 90% of your money for it to be qualified as franked investment income. If you're not getting the 90% of your gross money, it means you got the whole 100%. then it doesn't qualify. Second, evidence of deduction of withholding tax deducted as source is a condition that must be fulfilled before you treat it as a frank investment income. So it means that do not say, I have escaped it. That is important. It is important that you mandate, you make sure that you suffer that withholding tax. There's a benefit for that. Then, where the frank investment income did not form part of the gross turnover, where the frank investment income did not form part of the gross turnover, it should not be deducted from same in computing minimum tax. So it means that the gross turnover must contain your minimum, your frank investment income. Then when you are computing minimum tax, you will still need to deduct it. But if it is not forming part of it, then it should not be deducted. Now, the minimum tax is going to be 0.5% of gross turnover of the company less frank investment income. So you see here, if the gross turnover of the company is inclusive of the frank investment income, you have to less the frank investment income. But if the frank investment income is not inclusive, then you should not deduct. Now, based on Finance Act 2021, minimum tax is to be computed at 0.25% of gross turnover less frank investment income for either one of the 2 years, either for 2021 year of assessment or for 2022 year of assessment. You know, this Finance Act 2020 became operative in year of assessment 2021. So you need to choose which of them, which of these 2 years, either 2021 year of assessment, which is from January 1, 2020 to December 31st, 2020, or 2021 year of assessment. Now, this was done in a way to cushion in the COVID-19 pandemic issue. So they reduced the minimum tax by further half. So it means that for 2020 year of assessment, minimum tax was 0.5%. So a company can go and do 0.5% for 2020 year of assessment, come and do 0.25% in 2021 year of assessment, then in 2022 it goes back to 0.5. So the major minimum tax now from Finance Act 2019 is 0.5. But if your company is existing between 2021 and 2022, you can elect which of them, which of those 2 years will be used. Previously, before Finance Act 2019, there is a long way for you to determine minimum tax. You need to look at your revenue, if it is above 500,000 or below 500,000. You need to look at your gross profit. You need to look at your paid up capital and your net assets. You will now compare them with the various percentages. It was a cumbersome tax, but we are grateful for what happened in the Finance Act 2019. All that was gone. Now look at this illustration now. APAD Nigeria Limited has been in business for many years. An extract of the profit or loss of the company for the year ended December 31, 2021 reveals the following. Now we see revenue or turnover from the main business activities. is 25 million. So what does that tell you? That this company has reached the threshold. So the company is going to pay how much? 20%. Now, revenue from suspended operations. So these are separate calculations here. Revenue from suspended operations, expenses from suspended operation. Now, this is the profit from suspended operation. And now we have the profit is 1.1 million, which is added here. Then rent received gross. Now, normally your rent should be received as net. If you are receiving rental income, the person paying you your rent should pay you net of withholding tax. So it means that whatever you are paying to your landlord, the landlord is taking it as net. And you are supposed to file withholding tax in your landlord's name so that he will benefit from the withholding tax. But most times now, landlords takes their money in gross and you don't get to file withholding tax. So the the FIRS also should be mindful of that. But sometimes because of the law is blind, they take it that whether you are giving them full amount or not, they take it as net and you'll be made to now pay withholding tax. But now the landlord received net, but is going to record it as gross 750. Now, dividends received from APD. Your company is APAD and you bought shares from APD Limited. APD Limited must have paid them dividends in net. But when they are recording it as gross. That makes it a frank investment income, 2.4 million. Then we have revenue from other operating activities, 7.5 million. Expenses from other operating activities, profit from that is 4.7 million. That's the profit now that is going here. Then we are told to compute the minimum tax payable. So the minimum tax payable now, you need to check. We said what are the conditions for minimum tax payable? One, the company must not be a small business. This company is 25 million and so it is past the threshold. We check again, the company is not into agricultural business. If not, it would have been stated here. And the company is not within its first 4 years. It says the company has been in business for many years. So minimum tax is computable. How do we compute it? Look at the turnover. 25 billion is gotten here. Then look at the revenue from suspended operation is brought in here, 3.5 million. We just take the revenue, leave the profits, take all the revenues, take the revenue, the revenue. Want to get your gross income. That is what it means. Profit is not an income. Profit is not an income. So we are taking the revenue, which is 25 million. Suspended operation, the revenue is 3.5 million. Your rent is a revenue received gross, 3.5 million. Dividend is received gross, 2.4 million. And revenue from other operating expenses, operating activities is received gross, 7.5 million. When you add them together, you have your total revenue or your total turnover. So you see here, this is revenue from all sources. So it's not just only your main business activity. If your main business activity is not up to 25 million, but when you get your total revenue from all sources. This is what counts. So it is this figure here that shows whether you are going to be classified as small, big, or medium. So it could be that this revenue here might be less than 25 million. So somebody will say, because maybe this is 24 million and it's not going to be paying taxes. No. These other ones here will be so large that this total revenue or turnover will give you maybe 101 million. So this one here, your main business may be, let's say, 20 million. But by the time you add all other things and you get maybe 102 million, you see that you are looked at as a large business based on this final, and not based on just the main business that will make someone think that you are a small business. All right. Now that we've done that, this is your total revenue. This is not called gross revenue. It is total revenue or total turnover. So turnover, turnover is from your main business. Revenue is from all sources. So now, when you've done that, now someone will say, why did we include this dividend and we are now removing it? This is to show all sources of income. If we are to omit these two four, it's telling the tax authority that you didn't receive the dividend. So they need to see all sources of income. So you show workings, this is 39,150. Then when you remove this 2.4, now this is what classifies you. This last one here is what classifies whether you are a small company or a large company, because it is gross turnover, not total turnover. Your total turnover could be the same as your gross turnover if you don't have frank investment income. So it's not your turnover from your main business, but when you have taken your total turnover and you remove your frank investment income, it is this final one here that determines if you are a small business. Then your minimum tax here is 2.0.25. This is for what year? 2021. So maybe the company is taking advantage of that 2 years of assessment, 2021 and 2022. This 2022 year of assessment. This 2022 years of assessment. So you can elect to choose your minimum tax as 0.25, so far as you have not used it in 2021. So if a question tells you that you have used it before, you don't have to use it. But if the question says you have not used it, then you may want to use it. Some people will choose when to use it. How will you know when to use it? Sometimes when your gross turnover is so high, if the one for 2021 is higher than that of 2020, you need to use it on the one that was higher so that you pay something smaller as your gross, as your minimum tax. Okay, so this is minimum tax. Now the thing is this: must you pay your minimum tax? Must you pay the fact that you calculated minimum tax? Is it the appropriate tax to pay? The answer is no. Minimum tax is telling us that this is the very least tax you should pay. So it means that it's just like somebody is trying to um, make a an investment, and is looking in his mind that, okay, what is the minimum returns of investment I'm going to make? And he has calculated it in his head and say, okay, worst case, I will not receive less than this. So that's how the tax people is doing, because you see here, tax is like an income to the government. And they are saying that, okay, from this company, this is the minimum you are going to receive. So your tax that you are paying is revenue to government. So this is the minimum that you are paying. This is the minimum yield they are going to receive from you. So whether you are making a loss or not, whether your total profit, when you calculate your CIT and it gives you something less than this, they will say, okay, it doesn't bother them if your CIT is lower than your minimum tax. Your minimum tax is where they will take. But if your CIT is higher than your minimum tax, of course they will go for the CIT, because minimum is the least you should pay. So that's it. We've calculated minimum tax. If you are asked to calculate tax payable, which is your CIT, you need to calculate your CIT, then compare with your minimum tax, and you check which of them is higher. That is your tax payable. So it's possible your CIT will be higher than your minimum tax, so that's your tax payable. It's possible that your minimum tax is higher, and your minimum tax become your tax payable. But in this question, you are asked to calculate minimum tax. Look at illustration 2. We have revenue on turnover basis. Now, this is here in section 105 of CETA, as amended by Finance Act 2020. Gross turnover, like we read before, means the gross inflow of economic benefit during the period arising in the course of the operating activities of an entity whose inflow results in increase in equity other than increases relating to contribution from equity participants, which includes sales of goods, sales of services, receipt of interest, rent, royalty, or dividends. Now, the FRS is given a discretionary power. Use your discretion by virtue of Section 30 to assess and charge a company on a fair and reasonable percentage of turnover or trade. So it means here that when the FRS is doing their DEX audit or DEX examination, they can be they have the right to use their discretionary power to charge a fair percentage of your turnover. They'll be using it as your accessible profit. So by virtue of that power, they will charge a fair percentage. Now, some of the reasons why they will use that power is in these circumstances. If in the basis period or the year of assessment, there is no accessible profit, and so because they don't have accessible profit, they can use that percentage and take it as accessible profit. Also, you have accessible profit, but in the opinion of the FRS, these accessible profits are less than what you can expect to arise from that trade or business. You are doing a tech business, and people in the industry are making it big, and they are paying having accessible profit of 20 million, and you are bringing accessible profit of 5 million. So they might think that this is less than what is expected. You cannot defend it, So they will take a reasonable percent from your revenue and charge it as your accessible profit. Or sometimes the true amount of your accessible profits cannot be readily ascertained. Sometimes you send your bank statement, or sometimes you refuse to send your bank statement so that the revenue authority can check and assess. And you know that these revenue authorities, sometimes when you bring your bank statement, all your credit transactions are taken as revenue. And you know that there are some things that are private and you cannot prove it. And so they're asking you for your bank statement and you don't want to provide because you know that you have done some private transactions, you cannot distinguish. Some of them are loan, but there is no narration to show it's loan. And the FRS cannot determine. So they could have that discretionary power to take a reasonable percentage and discard what you have sent to them. Now, the implication of the above provision is that whatever is obtained by applying a fair and reasonable percentage, as may be determined by the FRS to the company's revenue, is deemed to be the assessable profit for the year of assessment. So, you may have to bring your revenue, whatever it is, and you are bringing this is your computation, self-assessment, and they are doing their intelligence and they are doing their back duty or their desk examination, and they have reasons to believe that this is not true and fair, even though you tick that box that you are providing an attestation that this is correct, and they are thinking it's not correct, they will apply that fair, reasonable charge. Look at illustration 8.3. Ojokoro Nigeria Limited is engaged in general merchandising. So because they're engaged in general merchandising, this is not an agricultural business. Two things happen here. Um, One, you will not be exempted from minimum tax if this business is more than 4 years. Capital allowances is going to be restricted to 2.3 of accessible profit. Okay, the following details were extracted from the tax returns submitted to the Federal Inland Revenue for the year of assessment 2021. Now, this is 2021 year of assessment. So, minimum tax is likely to be computed. But now, they said this is extracted from what was submitted. So, it means this is what was submitted. This was prepared by the company. They declared a revenue of 100 million. So that means they're still in the small scale business, small, medium business, right? Yeah. Then the accessible profit now is 5 million, 5.8 million. And you have a revenue of 100 million, and you're declaring 5 million. Wow. When they are looking at, because what the tax office is going to do, they're going to be checking the ratio of your accessible profit to your revenue. And when they see that it's far less than reasonable, they have reasons to believe that the filing is not reasonable for them. So they need to check your accessible profit. Then you have a balancing charge of 500,000. Of course, your 500,000, a balancing charge, you need to add it to your adjusted profit or accessible profit. And you have, this is your second accessible profit here. You brought it as 6,350,000. Okay. Then you brought your unrelieved losses 1.2 million, you less it from this accessible profit, you get your third accessible profit, which is used to compute capital allowance. And so capital allowance, maybe this was restricted to 2.4, 2.5%, 2/3, sorry, of accessible profit, which is this accessible profit, not this and not this. So 2/3 of this would have been the highest you take. But this is the capital allowance they charge, and your total profit became 2,650,000. Then 2,650,000. They now charge tax as 30%. Okay, so let me go with what this book is saying here. You remember the threshold here? They said 25 million and below is small business. Even though I don't agree that 25 million is small business, what the law says, when you have attained that range, once you hit 25 million, you are a small business. But this book is saying here 25, 0 to 25 million, small business. Then above 25 million, down to 100 million. Okay, down between 25 and 100 is medium-sized business, and above, from 100 million and above, is big business. So that means they include 100 million as big business. That is why they charge here at 30%. It's fine. That is how they interpret it here. No problem. Now, this is what was calculated. All right, 30% of 265 million, and it gives me 795,000. Is fine. Now, that's what you paid. Then when the tax authority were looking at the financial statement, they also extracted the following. Your gross profit was 9,780,000. I'm wondering, you have a revenue of 100 million, gross profit, that means your cost of sales was very high, about 90, 91, more than 91 million, for them to have this 9.78 gross profit. Okay, then your net assets happen to be 48.5 million. Your share capital is 30 million. It's a big share capital. Then the shareholders fund, which is the paid up capital, the shareholders fund is 48.5 million. So your net asset is the same thing as your shareholders fund. When you check your shareholders fund and you see finance by share capital, premium, and profits, all these ones are shareholders fund. It must be equal to your net asset. Your net asset is simply your total assets minus your current liability. That's your net asset. Your shareholders fund happens to be your equity and your long-term liability. So it means that this share capital plus your long-term liability, the long-term liability would have been 18.5, making your shareholders fund to be 48.5. Okay, so this is from your statement of financial position, but your gross profit is from your profit statement. So these are the extracts, and that is how they extracted this from your profit statement. Revenue 100 million, they extracted that, and they extracted all of this. All right, so now they now did all that extraction to now do their desk examination. In their desk examination, they revealed that profit revenue was understated by 5 million. So what it means here is that your revenue you quoted as 100 million, you were not saying the whole truth. Maybe either by omission or by commission, there's supposed to be 5 million on top of this, which was not stated, and so they detected it. Expenses were all overstated by 1.5 million. So it means that your expenses that gave you this net profit, okay, net profit was not given to us here, so net profit was not shown here. So your net profit would have been increased by 1.5 million because that expenses that you overstate, because you want to reduce your profit, you now inflated your expenses so that your profit will reduce. So this 1.5 would have been added back to your net profit. But now we can't use it because there is no net profit in our extracts here, because for this question is not important. The tax official observed that the accounts submitted by the company were not reliable, and that based on industry average, the gross profit percentage of 10% reviewed by the company was not reasonable. I said before that we have 9.78 when they compare gross profit to revenue. They have a gross profit margin. Your gross profit margin, that's ratio analysis. They found it to be about 10%, even less than 10%. It's about 10%, yeah, or less, and they said it's not reasonable. And so, because of that, the FRS decided to revise the company's income tax computation by applying a fair and reasonable percentage of 25% on revenue. Now, the question is, recompute the company's income tax liability for 2021 year of assessment, and we are told to ignore minimum tax computation. Okay, here specifically, we are told to ignore minimum tax computation. So look at the things here that matters arising. Your revenue is 100 million. You've seen it. And they said this was understated by 5 million. So it means 5 million is going to be added back to this. And they said your gross profit percent, your gross profit margin, this is what they use. This divided by this that you submitted. Let's see what's the percentage. Let's see what was the actual percentage of your gross profit. So let's act as if we are the tax um, controller or tax manager. Divided by 100 million, okay, times 100. So they brought 9.78. Their gross profit margin was 9.78, and it's not reasonable. So they have a reasonable range for companies in that industry, company of that revenue. So they have that range that if it falls below between this range, we take it as reasonable. So it doesn't fall between that reasonable range. And they said, okay, we are going to apply 25% on the revenue. So the onus on us is to look for what the real revenue is and apply 25% on it. So that's what is here. This is for 2021 year of assessment. Now they are going to do your revised assessable profit. It's going to be, we said that you brought 100 million, 100 million as your revenue. and they said it was understated by 5 million. So that means this is 105 million. That's your real revenue, 105 million. You now times it by 25%. So your accessible profit will now be 26 million 250. So that's what is here. 26 million 250 is your revised accessible profit. Then you'll now be adding the balancing. So instead of this 5 million that you have here, they have revised it to 26 million 250. You now add your balancing charge of 5 million or 500,000. I mean, you have 26,750. Then that loss brought forward. They are assuming that they allow it. Yes, it's reasonable. They said yes, we know about these losses. They remove the loss. You have 25,550. Your capital allowance, yes, they bring it down here. Remove this 2.5 million, still the same thing. So the only thing that changes here, everything here, this does not change, this didn't change, this didn't change. So what changed is the revision of your accessible profit. So this figure changed and it changed the calculation. So your total profit is now 23 million and 50 now instead of 2.65 million. So you see how this just only 5 million increase, only 5 million increase brought, number one, and the fact that the accessible profit is not reasonable. If they have not discovered that 5 million understatement, they would have just applied 25% on this 100 million. They would have applied 25% to get something big. So, but now they are applying 25% on both the one you revealed and the one they detected, and you have this as a total profit now. Then you are now looking at charging 30% tax, which gives you 6,915. Okay, so this is your tax liability. Now, normally, because this was not revealed, you would have been paying penalty of 5% on this. That's not part of your tax. That's a penalty. You would have been paying 5% penalty on this. Then you would have been paying interest. But that's not the scope of this particular thing here. But for real life scenario, that's what the tax office is going to be doing. Except you are going to do back and forth with them and write and they respond, or you talk to them and they see reason and they may waive the penalty and interest. But once it is on Tax Pro Max, it is deemed to be final and conclusive, except the tax appeal tribunal um, overturn their their use a judgment from the tax appeal tribunal to reverse that. So we've looked at revenue basis. The tax authority could apply fair percentage on your true revenue if they feel that your revenue that you have produced is not reasonable. If they also cannot determine your accessible profit, or if your accessible profit is less than the industry, eh, it's less than what is as expected to be arising from that trade, then they can use that to to determine your revise. So sometimes you'll be seeing deemed accessible profit. Sometimes you will see revised. That word deemed is like assumed accessible profit. It comes up a lot in tax assessment. When they are assessing your tax, you would have filed your self assessment and they are bringing theirs, and you'll be seeing deemed accessible profit. They would have applied a particular rate to your revenue. So you see your gross turnover, or you see your total turnover, you see your less frank investment income, you now see your gross turnover, and you are seeing the applicable rate, fair percentage rate, and you'll be seeing deemed accessible profit or revised accessible profit. Then you will not start seeing all these other add back or add or deduct to get your total profit, to get your tax. So that's how revenue basis is. You applied a fair percentage. Total tax, minimum tax is when you don't have, when there are some criteria you need to meet to pay minimum tax, which we have used as one of the bases. So we have seen other bases. We are not seeing uh, revenue basis. The next one is dividend basis. Just a moment, please. All right, we have the dividend basis. So we are asking now, why should dividends be a basis for assessing tax? Is dividends not supposed to be a frank investment that should be deducted for us to arrive at our total profit? Is the definition of gross turnover not supposed to exclude frank investment income, which dividend is? So, why is dividends a basis for a certain tax? Now, prior to Finance Act 2019, the provisions of Section 19 of the Company Income Tax Act states that where a dividend is paid out of profits on which no tax payable is due, they said where a dividend is paid out of profit on which no tax payable is due to accessible profit, or the accessible profit less than the dividend paid. So there are two things. You are paying dividends out of profit of which there is no tax is due. So you see, tax is not due because you don't have accessible profit. So accessible profit, you are making a loss. Now you are making a loss, no accessible profit, but you are paying out dividends. All right. Then also, you may not be making a loss. You may have a dividend. You may have a accessible profit, but your accessible profit is even less than the dividend you are paying out. So you know, dividend being paid out, dividend is post-tax. Dividend being paid out is higher than the accessible profit. The company paying the dividend shall be charged to income tax at the rate, at the appropriate rate on the dividend paid. So it will be taken as if the dividend paid is your total profit for the year. So it means here that before 2019 Finance Act, if anybody is paying dividend, let's say your dividend is 1 million naira gross dividend, and your accessible profit for that year that you are paying out that dividend is zero, or you are making a loss, but you are paying out 1 million naira dividend, they will take it as your dividend paid is your total profit, and they will charge tax on it. Okay, now if you are paying dividends and you have accessible profit and it's less than dividend, let's say the dividend is 1 million, accessible profit is 800, they will take your dividend paid as your accessible profit. How does it come about that way? This is because prior to Finance Act 2019, whenever dividend is paid out, you are required to pay tax on the dividend. So what it means is that as you are paying dividend out, you are charging the FRS is charging you 30% on the dividend paid out. That's one. You are also paying dividends out. You are charging withholding tax, which you will remit on behalf of the people who are receiving the dividends. So that way, you are the agent for the government, collecting minimum tax and collecting withholding tax and remitting. But the government is charging you for just paying out that dividend. They are charging you 30%. So imagine you pay 30% of 1 million and you don't have any dividend accessible profit for that year. The government will not refund you. So for paying dividends, so that they call it dividend tax. Note that dividend tax is different from withholding tax. Withholding tax is the tax you pay for advance of your income tax. But when you are paying dividend, you are paying out dividend, there's a dividend tax which is the same applicable tax rate, 30%, and you make no profit, you have paid tax on your dividends. Or if your accessible profit is less than your dividend, you have already paid tax on it. But if you now have a dividend, if you now have an accessible profit or total profit higher than your dividend, of course, the difference. So let's say your total profit happens to be 1.2 million and you charge your tax 30% of 1.2, you got a figure. You need to deduct the tax you paid on your dividend. Then you pay the balance. So you see here, dividend basis, you would have paid tax on dividend you paid out. The person who receives dividend, the person who receives dividend is going to take it as franked investment income. But you who is paying out dividend, when you are paying out dividend, it is not frank investment income because it's a payout. Payout is not an income. So, but when you are paying it out, you are paying tax also on it. You pay 1 million, you're also paying tax on that. That was what is being stated. Now, the Finance Act 2019 excludes the following classes of dividends from the same treatment as those above. Dividends paid out of retained earnings from the company, provided that the direct dividends are paid out of profits that have been subjected to tax under the Company Income Tax Act. So you see here, this is a reasonable thing because these dividends you are paying out had been subjected to tax before. So why pay dividend tax? Okay, now, so far as it has been subjected to income tax, petroleum profit tax, or capital gains tax, if you are paying it out from that, then it is exempt. Then dividends paid out of all tax exempt income. from pursuant to CGTA, PPT, and the Pioneer legislation, that is the Income Tax Relief Act. All those ones are exempted. All frank investment income, then distribution made by a real estate company to its shareholders. So it should be noted that the exemption still applies whether or not the profits that generate such dividends accrue in a year other than the year in which the dividend was paid. So it doesn't matter whether the dividend was earned last year or last 2 years and you are paying it out this year, the exemption applies. Let's look at this illustration 8.4 to see if we get the sense of it. And let's start from the financial statement of ABC Limited and XYZ Limited for the year ended 31st December 2020. Reveal the following. And look at ABC and XYZ, the total profit for the year. Now, total profit is the same, it's not the same thing as net profit. Total profit is the taxation profit where tax is being computed. This 3,600,000, this is 1 minus 1.2. Retained earnings brought forward. Retained earnings. Then we have dividend declared in 2020, paid in 2021. Now, look at what was disclosed in the financial statement. Now, out of the dividend of 4.2 million paid by ABC, only 600,000 can be regarded as being paid out of retained earnings. So 6,000 was regarded as paid out of retained earnings. So because this 600,000 was paid from retained earnings that has suffered tax, this 600 will be exempted. Then 3,600,000 shall be subjected to the application of section 9.1. So it is based on this 3,600,000 that you can apply that dividend basis. You don't apply it on the 600 that has been suffered that has suffered tax before, paid out of retained earnings. Now, 750,000 paid by XYZ Limited was not paid from current year's loss. Was not paid from the current year's loss. Hence, this amount will not be subject to the application of section 19.1. So it was not from the current year loss. So this was from, no, we have a loss here. This is the loss that was made this year. This is the loss. I think this is the total loss made this year, and now they are paying dividends. This dividend is not paid from current year loss. It is from, so this 750 was not as a result of part of the activities for the current year. Of course, it must have been from retained earnings that was brought forward that they paid this 750. So it will not be subjected to dividend basis. So only this 3,600,000 out of this 4,200,000 will be subjected to dividend basis. Okay, so we've seen three bases. We've seen dividend basis, we've seen revenue, we've seen minimum tax. Now, dividend distribution. Nigerian dividends received by companies that are not Nigerian companies. Now, when dividends are received by a company, that is not a Nigerian company, or it didn't engage in trade or business in Nigeria at any time during the year of assessment, no tax shall be charged on it for that year in respect of the dividend received by it from Nigerian company, apart from withholding tax. So a company from uh, maybe US or Canada is paying a Nigerian company a dividend. Now, this Canada company did not do any business in Nigeria, or is not engaged in any business in Nigeria, but it's paying dividends to a Nigerian company. So, by virtue of the fact that a Nigerian company is receiving it, that Nigerian company will suffer dividends, withholding tax on dividends. And that dividend it is receiving, of course, is going to be paid into a domiciliary account. No tax will be charged on that dividend except withholding tax. So withholding tax is the final tax on that company. Where any dividend is paid out of profits for which no tax is payable due to no total profit, or total profits which are less than the amount of dividend which is paid, whether the recipient of the dividend is a Nigerian company or not, the company paying the dividend shall be charged to tax at the prevailing income tax rate, as if the dividend is the total profit of the company for the year. I've explained that. So whenever you are paying out dividends, if there is no profit, or the total profit is less than the dividends you are paying out, you will pay a dividend tax. That's the same thing they are saying. And it will be taken as if the dividend is the total profit of the company. Then we have undistributed profit of a Nigerian company deemed to be dividends. Any amount of undistributed profit of a Nigerian company which is distributed under provision of any law in force in Nigeria shall be deemed to be income from a dividend accruing to a person who is a shareholder in the company, in proportion to his share in the ordinary capital thereof at the relevant time. And the income for the dividend be taken for assessment in his hand shall be his due proportion thereof, increased by such amount as is specified by the relevant tax authority. So what it means is that you have undistributed profit, and the tax authority is deeming a portion of it as distributed. They will see it as dividends in the hands of the shareholder. Now, whether you have distributed it or not, they are deeming it, they are assuming it to be dividend in the hands of the shareholder. Anti-abuse. Any attempt by any company to split the transactions that were carried out prior to the commencement of the Finance Act amongst two or more companies in order to enjoy the exempt, to benefit from the exemption of profit of small companies, shall also okay, so in accordance to section 22 of CETA, they said shall discountenance such splitting and aggregate all transactions to comply originally before the Finance Act. So what they mean here is that because you have um transactions that normally one company should have done, and you want to, and that transaction will make your company hit 25 billion or that or thereabout, or 100 million or thereabout, you now decide to open a company, split the transactions into this company so that it will reduce the effect. Then you will not be paying tax in the two companies. Let's say you have 40 million that you are supposed to pay tax on, you now split it 20 million here, 20 million there, and you don't pay tax. So they shall discontinue that for you and aggregate all the transactions as if it is originally coming from one company so that you'll be paying the tax. After the commencement of Finance Act 2019, any attempt by a taxable person to incorporate new companies or use two or more companies to transact a business which, in the opinion of the service, is aimed at benefiting from the tax exemption of profit of small company, the value of such contracts shall be aggregated and taxed in the hands of one of the companies. So they know that people will want to benefit by opening two or three companies and be doing one thing that one company should be doing. They are using three companies to do it and get benefits. So they will aggregate it and tax it in the hands of one of the companies. In line with Section 42 of the IFRS Act, any company that conceals its turnover with a view to obtaining tax benefits available to small companies shall be prosecuted with its directors and relevant principal officers. So it means that here, if a company is trying to conceal its turnover so that it will benefit from the small company, not pay tax, the directors will be prosecuted, the principal officers, that is the managers, even the accountant, the tax advisor, all of them will be prosecuted. Any tax liabilities arising from the foregoing shall be recovered along with penalties and interest. So you see, when you conceal your turnover, like the case of the example we did that they discovered that their turnover was understated, it will lead to interest and penalty along with collection of that turnover. They will bring that turnover to make an additional assessment of tax based on that penalty, interest, and the directors will be prosecuted. So that's it for concept of turnover. Let's look at some of these works example and see how we can test our knowledge. Empire Nigeria Limited is owned by Nigerians and has been in business since 2003. The results of the company as at December 31, 2020 are as follows. So this is far more than 4 years. It's not into agricultural business. So what do we look at? Look at the assets employed. We have the non-current asset, which is 180 million. The current assets less current liabilities. When you add them, this is net current assets. When you add your non-current assets to your net current assets, you have your net assets. So this is your net asset, which is also still going to be your finance by your share capital, your statutory reserves, general reserves, every other thing gives you 370. Okay, so most times when you see net assets in your question here, when you see net assets prior to Finance Act 2019, when you see net assets, when you see share capital, when you see gross profit and revenue, it tells you that you are going to be calculating minimum tax. So this company is not exempt from minimum tax, and you see your net asset is one of the things we use in calculating minimum tax in those days. Then we have share capital, which is another ingredient. We need to look out for revenue and gross profit. So you are provided the revenue of the company during the year was 240. This is another ingredient. We need the fourth one. gross profit was 35 million. So the ingredients for computing the minimum tax has been provided. Then we have the assessable profit 2.1 million, unrelieved capital allowances brought forward from 2020 year of assessment was 600 million. Capital allowances for 2021 amounted to 950,000. We are required to compute the company's minimum tax liability for the year of assessment. Compute the company's income tax liability. It said, note, ignore restriction on capital allowance, then differentiate between direct and indirect taxes. So this question is kind of a trick question. Before the coming of Finance Act 2019, these ingredients I put out here, I marked out here, was used to calculate um, minimum tax. And I usually call it, I usually use this formula to get them. I used to call it gap T. So this is gross profit, net assets, paid up capital, and revenue. So this is supposed to be 5, 5, 25, 25, 125. This is another 25. And this is 125. Building up something here. This is where I used to build up the formula. And this is 0.5, 0.5, 0.25, 0.25, 0.125. This percentage, 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 percentage. Now you need to look for this 4 and compare the higher of these. Now this turnover, the turnover is turnover of 500 million or 500,000 rather. Then here is excess above 500,000. So after getting the higher from this 3 or from this 4, you now compute this and add to this. That was how the minimum tax was computed. Okay, so what I will do here, I will also compute what it would have been in the last regime. So this is the solution here. Okay, let me make another instance of this so that we'll not be opening too much. Okay, so this is where the solution is. So we are told that our revenue is 2.4. So yes, our accessible profit was given to us here as 2, okay, sorry, computation of minimum tax. We use 0.25% of your turnover. So your turnover here was 240 and we calculated it as 0.25%. That was your total, that was your minimum tax. But look at how it was calculated before. Look at how it was calculated before. Sorry. Like I said before, it used to be gap T. So this is gross profit. This is net assets. This is paid out capital, and this is turnover not exceeding 500,000. And this is excess of turnover above 500,000. Okay, so I said this is 5 plus 5 gives me 20. 5 times 5 gives me 25. I repeat my 25 again here. Then I have my 125. So I'll come here. This is 0 point, 0 point, 0 point, 0 point, 0 point. And this is a percent. 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 Then I'll have my multiplication. So what's my gross profit? My gross profit here is 335 million. Gross profit is 35 million. So what will be my figure? Gross profit 35 million. I'll bring out my calculator and now check 35 million multiplied by 0.5 divided by 100. That's 175,000. So I will check. This is 175,000. My net asset here is 370 million. 370 million. 370 million. So I will check now. 370 million times 0.5 divided by 100. That gives me 1,850,000. 1,850,000. Okay, so I now check paid out capital. So it's assumed that this share capital is paid out. Sometimes they will tell you it's paid out. It's not told. You assume that it's paid out. 140. So that's one of the reasons why CAC, each capital share capital you want to register must be fully paid. So 140, because sometimes they used to have unpaid capital. So this 140 million has been paid. So I'll come here. This is 140 million. I'll look for 0.25%. So this is 140 million times 0.25 divided by 100. That will give me 350,000. Then we have turnover not exceeding 500,000. So this is going to be 500,000. So we look for 0.25% of 500,000 multiplied by 0.25 divided by 100. That's going to give me 1,250. Then out of all of these, this is the highest. So you now pick, you now say highest of the above will now be 1,850,000. And that's the highest of the above. Then this now will not be 0.125% off. Now, you now need to look for what is the revenue here? The revenue is 240 million. So it's going to be, the revenue is going to be 240 million, 240 million, now minus 500,000. Of course, you have taken the first 500,000. The remainder is what they are asking you. So you will say 240 million minus 500,000. Now this is what you are going to use to multiply by 0.125%. So divide by 100. So this is 299,375. 299,375. Will you add them together? 299,375 plus 1,850,000. It gives you 21,2149,375. 21,375. So this is minimum tax. So this is minimum tax prior to Finance Act 2019. Now compare this with Finance Act 2019. Minimum tax happens to be 0.5% multiplied by 240 million. Just one figure, less ambiguity. We have 240 million times 0.5 divided by 100. And that gives you 1,200,000. 1,200,000. Now, in the coming of Finance Act 2020, Finance Act 2020, minimum tax is either you use it for 2020 year of assessment, 2021 year of assessment, or 2022 year of assessment. So it's now going to be 0.25 for just either of them times 240,000, 240 million. And that gives you 240 million times 0.25 divided by 100. So this is like half of the other one, 600,000. So these are the three ways. So this last one here is most appropriate. You can also use this 1.2 million in your exam. Never this. Never this. Now the reason why I had to do this is because if the question is giving you year before the Finance Act 2019, then this is how you will calculate it. It's giving you 2020 year of assessment. You will do this. But if it is giving you 2021 or 2022 year of assessment, so you would need to either use this or perhaps this. All right, so that's it. That's how they got this 600 here. Now you are also asked to compute the company's income tax liability for 2021 year of assessment, the Company Income Tax Act. So now your year of assessment is 2021. Your assessable profit, as we are told, was 2.1 million. Okay, then you need to deduct. Let's see whether there are some add backs. Okay, they didn't tell you, all these ones are, they didn't tell you anything about things you add back. No on no disallowable expenses here. So this is your loss that was unrelieved. Okay, you need to remove your loss. So that's what they gave here. Loss unrelieved here is 600,000. After relieving your loss, you need to bring your capital allowance for the year. 950 was given to us here. 950. When we remove them, we now have a total profit of 550,000. Then you need to check your company income tax. 30% of 550. Why is it 30%? Because your revenue was 240 million. Then your education tax is 2%. Why is it 2%? 2021 year of assessment. 2.5% if it was 2022 year of assessment. Then 3% in 2024 year of assessment. 2023, part of 2023 and 2024 is 3%. But you won't be given anything that you'll be asked to use 3%. So to just know when to use 2% and when to use 2.5%. Right? Then we are asked again to look for the differences between direct and indirect taxes. Direct taxes are taxes on income, profit, or other gains, and these are paid directly to the tax authority. Example of that is company income tax. It's directly involved in your income. Then your personal income tax, petroleum profit tax, education tax, withholding tax, capital gains tax. All of these are direct taxes. Then indirect taxes are those taxes that are not from your income, but on your spending, on your spending. So on your consumption. So value added tax, then there's your sales tax or consumption tax, excise duties, stamp duties. All of these are direct taxes. Let's look at this other question here that was said here. The managing director of Bowling Nigeria Limited attended a workshop during which he came across the following tax matters under the Company Income Tax Act as amended. A. Classification of Nigerian companies based on the provisions of Finance Act 2019 and Finance Act 2020. Provision of Finance Act 2019 on dividend basis of income tax, companies income tax. Treatment of losses in the ascertainment of total profits and incentives with peculiar reference to research and development. In his return to the office, he requested the finance director to explain these tax matters to him. The finance director did his best to explain to the managing director, but he was not satisfied with the finance director's explanation. The managing director invited a tax consultant whom he met at a workshop to explain the four items. As the tax consultant, you are required to explain the provisions of the Company Income Tax Act, Cap C21, Laws of the Federation of Nigeria 2004, as amended, with respect to the four areas of interest identified by the managing director. So now you are acting as that, and you have to provide that in a letter, a formal letter. So this is your company name, chartered accountant, this is your letterhead, your date, and you're addressing it to the director. Read tax matters. So let's look at it here. Further to our discussions at the last workshop, please find below our explanation on the four areas of interest as identified by you. Classification of Nigerian companies based on Finance Act 2019 and 2020. The provision of the Finance of the Company Income Tax Act prior to the commencement of Finance Act 2019 was that all companies are liable to the same company income tax rate at 30%, with the exemption of small business which brings a turnover of less than 1 million that are taxed at a reduced rate of 20%. The Finance Act 2019 has classified companies into various categories with different tax rates as follows: type of companies, basis of classification, applicable rates. Small companies, annual turnover of 25 million and below, 0%. Medium size, annual turnover of above 25 million but less than 100 million, 20%. Large companies, annual turnover of 100 million and above, 30%. Implication include small business are still required to register for tax, prepare audited financial statements, and file tax returns as at when due. Small companies are no longer liable to withholding tax on their income, since withholding tax is an advance payment of income tax. And Finance Act 2020 stipulates that the Federal Inland Revenue may prescribe the form of account other than audited financial statements for small and medium-sized companies as defined under SITA. We've done with A, the B part, provisions of the Finance Act on dividend basis of company income tax. The Finance Act 2019 introduced changes to limit the application of tax to only untaxed profits that are not exempt from tax. The implication of these amendments are that the following no longer count in the determination of excess dividend tax: retained earnings on which adequate tax had been previously paid under SITA, PPTA, or CGTA; exempt profit as in the pioneers profit; franked investment income, you know that; dividends by real estate investment company out of rental and dividend income. The year to which profits relate to is now irrelevant, and the possibility of a company paying excess dividend tax is now limited. Then you see the treatment of losses, the ascertainment of total profit. In ascertaining the total profit of any company, losses are deductible from the total accessible profit from all sources. The conditions to be met for losses to be deducted as contained in section 31 of SITA as amended are: 1. The board must be satisfied that the loss has been incurred by the company in any trade or business during any preceding year of assessment. The aggregate deduction from the accessible profit or income must not exceed the amount of loss. The loss can be carried forward and deducted from the same trade or business without restriction on period. The loss sustained by a non-resident company that indigenizes its Nigerian operation shall be deemed to be a loss of the reconstituted company in its trade or business during the year of assessment in which it commenced business, and shall be deducted from the profit of subsequent assessment years. This C part, when we treated loss relief, this is your knowledge about loss relief. Then D, tax incentive with particular reference to research and development. Section 26, subsection 1, 2, and 3 stipulates that in the ascertainment of profit, or losses of a company from any source chargeable to tax, there shall be deducted the amount reserved out of profit for that period by the company for research and development. The allowed deduction for research and development shall not exceed 10% of the total profit of the company for that year. Where the company or organization is engaged in research and development for commercial purposes, the incentive is 20% investment tax credit of the qualifying expenditure. So these are some of the things you are going to tell them, then you close with your letter. So one of the reasons why the study pack in ICANN is my basic note is that sometimes questions from the exam are usually taken from the pack. They may change the figures, they might change certain things, but they also come from the pack. This has been noted over time. And you see some of the comments they will tell you is the study pack of ICANN should not be ignored. So most times this is my source document for the lecture. Okay, so that's it. Let's look at this other question. That will be the last. Conversion of Abia, Biodu, and Clement and Co. Company to ABC Consultants. Okay, so this same question has come up in ICANN question on merger and acquisition or so. Abia, Biodu, and Clement, based in Makurdi, Benue State, have run the firm Abia, Biodu and Company and Clement and Company as builders for several years. The partnership agreement provides for the following: salaries to partner for Abia, Biodun, and Clement. Look at their sharing ratio: 1 over 5, 3 over 10, and 1 over 12. Okay, that's the sharing ratio. In January 2010, there was a decision to review the partnership agreement. Messrs. Abia, Biodun, and Clement have been unable to find worthy successors to take over as partners. Rather than review the partnership agreement, they decided to convert the partnership into a limited liability company. In view of this, a firm of chartered accountants was contacted to incorporate the name ABC Consultant Limited. The authorized share capital of the proposed company was 10 million, made up of 10 million ordinary shares at 1 naira each. The details of the shareholding structure was agreed as follows: Abia will take 20%, Biodun 30, Clement 50. They are all associates. No one is having 51%. The certificate of incorporation was approved by the Registrar of the Corporation of the Corporate Affairs Commission, Abuja, on August 1, 2010. The certificate of incorporation was dated 10th of August. Wow. 10th of August was the date it was dated. So that is the date of incorporation. The company commenced business on October 1, 2010. The cost of incorporation includes payment of stamp duty 80,000. Yes, if 1 million is 8,000 stamp duty. So it's 8%. So let's check something here. It's 8 naira for every 1 million. No, for every 1,000. So 8 naira for every 1,000 naira. So this 8 divided by 1,000 is 0.08%. Okay, times 100. So it's 0.8%. So 0.8% multiplied by those. So this 10 million. divided by 100. So that's 80,000. So that's fine. Payment of stamp duty is 80,000. Professional fee for incorporation, yes, this is reasonable, 50,000 naira. So it means that the professional, the accountant charge is fee 50,000. Then corporate affairs commission fees 100,000. I think it's a little high. Corporate affairs did not take this much, but this just for exam question. Additional cost of incorporation. This could be other logistic charges, and everything amounts to 270,000. All right. The financial results for the year ended 31st December 2010 are as follows. We have our income, which is our revenue, which is income 4 million. Now there are less cost of incorporation. Now this is where I have a problem. This cost of incorporation, they included it in the things that they are lessen. Transport and traveling, medical expenses, hotel and accommodation, audit and accountancy, postage and telephone. Then we have salaries. So this is salaries of partners before, and now these are salaries of directors. This one are supposed to be part of the appropriation. Then we are not told that fees and expenses were earned and incurred evenly throughout the year. So it means that it is even. If you divide it by 12 months, means that divided by 12 months is an assumed rate. Average of 1 month is allowed here. You are to write a report to Messrs. Abia, Biodun, and Clement, highlighting any one tax implication of the decision to convert to a limited liability company, limiting yourselves to the facts and details provided in the case study. One of the tax implication here, you need to pay stamp duty on the incorporation. Okay, we'll see that from the solution. Now, your comment on the breakdown on the cost of incorporation of 270 and the tax implication of each item. So you see here, these 270, I underlined them, which is these figures here. We need to look at all these figures one by one and talk about their tax implication. And the compass, okay, no, we're not going to do this, so you look at this one yourself. So let's look at this A and B. Tax implication of conversion. So you are writing your letter as before, so I'll just go straight. Tax implication of conversion. The partnership ceased, yes, so cessation of partnership business on the last day of business incorporation. So of the last day of business, the first day of the business, the new business was October 1. Even though the company was incorporated on August 10, the partnership was still carrying on. It has not ceased. So the partnership ends in 30th September. So cessation rule will apply on the partnership that is going away. Then commencement rule will apply from October 1, 2010, when this new company commenced operation. Then the corporation expenses shall be applicable to ABC Consultants Limited. So the incorporation expense by will not be borne by the partnership. It will be borne by the company, and it is not an allowable expense because this is pre-operational expenses. Now, The reason why we are told that all these fees and expenses accrued evenly throughout the year is because from January to September is 8 months. 8 months of all of these belong to the partnership business, whereas the 4 months, October, November, December, 9 months belongs to the partnership rather. Then 3 months belong to the company. So proration of 3 months of all of these belongs to the company. So income 3 over 12 of 4 million belongs to company, 9 over 12 of 4 million belong to partnership. This whole 270 belong to the company, neither of it should be prorated to the partnership. That's what we are saying. So the incorporated expenses shall be applicable only to ABC Consultant Limited, and it's not an allowable expense. So it's going to be disallowed when computing that of the company. The ABC Consultant Limited will be required to register with the Federal Inland Revenue for the purpose of company's income tax, special education tax, value added tax, withholding tax, and other taxes due to the company to FRS. So this time around, you'll be getting TIN. You'll also be registering it in Tax Pro Max. ABC Company Consultant Limited, in accepting the incorporation expense, shall deduct and remit withholding tax from professional fees. So these professional fees here, professional fee, 10% of it is withholding tax. If the beneficiary is a company, or if the beneficiary is an individual, to be 5%. So they said just one, they just need one implication. So you can take any of these. Then tax implication of the cost of incorporation. Now let's look at it. The total cost of 270, though paid through the partnership period, shall be considered as pre-operational expenses of ABC Consultant Limited. Said that, so it's not going to be an allowable expense in the partnership, neither is it going to be an allowable expense in the limited. So it's going to be as pre-operational expense for the company and not considered part of the partnership. The pre-operational expenses, when added back, will increase the taxable income of the limited company, thereby increasing the tax payable. The 270 charged to ABC Consultant Limited is not an allowable expenses for tax purposes, even if it is spread over a number of years. It's not allowable. So it's always going to be added back. So three things here. The 270 belongs to the company, not the partnership, to be added back to increase the tax payable, and it will not be spread for many years. So this is how you are going to be writing your reports, and you stand a chance of scoring some marks. So that's how we come to the end of our tax class tonight. So you shall do this last example yourself. Take note of some of the things that we've learned here and apply them in your solution. So what have we learned today? We have learned the concept of total profit. You see that total profit is gotten from accessible profit or adjusted profit, which is first gotten when the net profit is adjusted, adding back all the disallowable expenses, add all the income that was not shown, that was hidden before, that was understated, adding back, adding expenses that were overstated, and deducted before. Then you now less allowable expenses that was not deducted. You remove other non-taxable income that was included. You now get your adjusted profit. After getting your adjusted profit, the next thing to do is to look for your loss relief and add it back, and add it, not add back, you add it. Then you have balancing charge to add, if there is any. Then you have your accessible profit number two, which you will now charge capital allowance on it. And if it's a company that is going to be restricted from the two-third, to be the two-third of that accessible profit that is derived before you start calculating capital allowance, then you get your total profit. We've seen the tertiary education tax 2.2% and 2.5%. It will be charged on the adjusted profit, which is the first accessible profit. We've seen the ratio 50% for university, 25% for tertiary, for polytechnic, and 25% for COE, College of Education. We've seen that there are other bases for calculating taxes, which is minimum tax is also there. We've seen how it was calculated prior to Finance Act 2019. I gave you the GAP TT formula, and we now saw the ones that was used for the Finance Act 2019, 0.5%, and it is the one from 2020 that asked you to choose either 2021 or 2022 year of assessment at 0.25%. Then we saw the dividend basis. We see that the dividend basis is any dividend paid out of profit of which tax has not been charged. You see all the exemptions from that. You will need to pay the applicable tax rate. We also learned the turnover basis, a fair percentage will be used when the profit is cannot be ascertained, the total profit cannot be ascertained, the accessible profit cannot be ascertained. Use a appropriate fair wage or fair percentage whenever the accessible profit that is presented is not reasonable. We also said in dividend basis that if dividend is paid for the year and there is no accessible profit or total profit, the dividend tax, the dividends paid is seen as the total profit for the year, and the appropriate tax will be charged. We saw companies that were classified as small businesses, 25 million and below, medium size between 25 to 100, and the big or the large size above 100 million. And their tax rates 0%, 20%, and 30%. We saw all of that, and we saw um, that's all that we saw. Yeah, and the how to calculate the minimum tax. We saw profits distributed by a Nigerian company. We saw also frank investment income, and we saw how to avoid abuse. Some companies will be registered to take advantage of the new provisions of the Finance Act. The FRS is going to aggregate every of these activities and use it as though only one company existed and we are doing all of these activities. So that's it. Come to the end of today's chapter. So what I advise you is look out for many of the tax questions that you'll be seeing. You'll be seeing a lot of questions that fall under these. We'll be looking at them. The next class will be looking at, probably we'll be looking at um, tax liabilities, where we'll be seeing dealing with allowable and disallowable items, how they are being how they are being used, how to know which items are allowable, which items are not allowable. We'll get to find out that, so that when we are solving tax questions, because these form about 50% of your questions, you are going to be seeing how you do them. So thank you so much for coming to class today. It has been an eventful one and an enjoyable one at that. And I will see you in the next class.